Are we timing the market here?
Kavita, yes, more or less, you're not timing, but you're at least trying to decipher if there is some better, relatively little better time to invest. That's what we're trying to see if the data crunching helps us just get the little tad more,
Right.
if possible.
Right. So let's get the data from your research team. What do you have to say? Like, maybe if someone is a first-time investor and just with the equity markets, in a year's time, you say that there are specific times when you should, and in fact, if you do, you can really yield the wealth in a longer-term perspective. How many opportunities are we talking about over here in a year?
See, Kavita, one thing which has come out reasonably clearly is that the initial parts of the year are great times to invest. Not scientifically proven, but this is reasonably good evidence. Like you see, January, last 5 Januaries, all of them Nifty has been negative. That's not just a coincidence. If you look at 14 months, 14 times in January, out of the total 23 times, Nifty has been negative. But in the latter part, you'll just find about 8 to 9 months out of the total 23 which have been negative. So Jan, Feb, March, and April are relatively great times to invest to get that 0.5%, 1% more. Basically, because April is also a part of that, I think bonuses coming and lump sum investments during those periods when you top up your SIP folios with some additional units which you buy one time could be a good strategy. That's point one. Point two, the age-old myth which has been there in the capital markets is December is a bad month for the markets because the FIIs want to wrap up their show before Christmas. That clearly is exactly the opposite. The maximum number of months of the December is the maximum positive months over the last 22 years where we have seen. But the contrary to the belief that December is a slow month for equity markets.
So, Feroze, these timelines are specifically for those people who want to start their investment journey, or is it even applicable for people who are into regular investing, maybe through an SIP, or they have their schedules on track?
See, I think, Kavita, I think this is more information to somebody who's a little more seasoned investor because I think efficiency comes in second. First is to begin. Most investors who keep procrastinating and not invest, they should begin to invest. Then you try and see if there were some little efficiencies possible to make it a little better. That's for a graduated investor. So, point one, if you're a new investor, you should begin your SIP come what may. Second thing is you have to be patient with your SIP. Markets have this tendency to test your patience. When your patience is least, the probability of making money is the highest. There's enough evidence to give a merit to this case. So if you look at COVID, when all hell had broken loose, most people had given up hope. But the subsequent year, Nifty went up about 70% in FY21. So when all hopes are lost, is when market gives you a springs you a surprise. Like just a couple of months back, whenever I speak to any market participant, they were very pessimistic. And that's when I thought this pessimism actually indicates that the market will go up. And it so did. And we are back to 18,400 kind of levels today. So point is, be patient, start your SIP. If you're a new investor, irrespective, just start. And I don't think it'll disappoint you over the long run.
Going with these observation, Feroze, now if you have to invest in the first 4 months, like say someone has tried putting their money maybe in Jan, by end of the year, how much do you think they could land up earning? Because looking at the observation and the trend analysis, first 4 months are clearly the best months, if I can say, to invest.
A good month to invest because of the market being subdued. That having said, even if in a mid-year, let's assume July, if you get a correction, every time you see falls of 5, 8, 10% in short spans of time, you should always try and empty your bank accounts and move that into equity, irrespective of which month you are in. But 4 months are definitely reasonably good because they've been more negative than positive. So when you accumulate units, when the units are cheaper, is always better. Now, of course, it's a little more courageous decision to do when markets are down. Putting in money requires steel nerves. Please exhibit those steel nerves and the markets will reward you. Having said which, Kavita, if you look at how capital markets or equity markets are little more perceived to be more riskier than they actually are. If you look at these 22 big years of this century, there are only 4 calendar years when the markets have been negative. The 18 other calendar years, markets have been positive. But when you speak to market participants, they think there's a 50% chance of losing money, 50% chance of making money. 81% of the years in this century, calendar year wise, markets have been positive. So, thoda zyada badnaam hai equity market, more than the data throws out.
Right, but then this observation or these trends are also visible on your fund's performance. Do they mirror? Is there any reflection?
See, when you look at fund performance, it's a very diverse universe, Kavita. Quite most of the shows you always say there is a plethora of funds, and those plethora of funds behave very differently. You're so right when you say it's so difficult to choose from 380 active funds. 380 active funds. Take a minute to fathom this number. Those are the number of active funds. If this is the universe, the best and the worst every year have a 30% difference in performance. So it will not be right to say all of them mirror the market. Like last year, the best and the worst fund in these 380 active funds had a 45% performance difference in a single year. In 365 days, the best and the worst had a 45% difference. So there'll be some who do worse off, significantly worse off than the market. There could be some which would do significantly better off from the market. So scheme selection is one skill which people can't ignore and underestimate the power of scheme selection.
I can see there are some fund recommendation also coming from you. These fund recommendation are based on what criteria? The performance?
No, Kavita, see, performance is a very clerical thing to do. You can arrange all the schemes in the descending order of performance and choose them. But that's like chasing your own tail. We have realized and we've done some study to see that funds are very cyclical. They're very cyclical. If they're cyclical, then you can't choose a fund and stay or choose a fund on the basis of past performance. We also had done a study a few years back. Out of the top 10 schemes of the last year, only 2 of them remain top 10 in the next year. So 8 of them slip from the top 10 category. If past performance is not going to be indication of the future, so what should that be? The criteria be? So we do a lot of analysis in terms of some degree of statistical variables are tested using regression model, which is proprietary. We also try and find out what is there in each scheme stock-wise and find out the targets of those portfolios and several other steps of subjective and objective evaluation, which are more forward-looking than backward-looking. On that basis, we choose some schemes which become the model portfolio schemes for that particular year.